While the gains in the S&P 500 this year have been largely attributed to the Magnificent Seven, of course, could it be time for the rest of the index to have their time to shine? Bank of America Strategist expecting the other 493 stocks in the S&P to post quarterly growth since the fourth quarter of 2022. For more, let's welcome in Ohsung Kwon, BofA Securities US equity strategist. Ohsung, it is good to see you. Ohsung, maybe we should start big picture because it is earnings season. Banks coming at us on Friday morning. Just sort of big picture, broadly, Ohsung, what are you expecting this earnings season? What are you looking for?
Yeah, thanks for having me today. I think this earnings season is going to be another pretty good earnings quarter for the S&P. We're expecting a 2% beat for the S&P 500 overall, which is actually the smallest beat that we're forecasting since Q4 of 22, but it's basically in line with the historical average. And the good news is that I do think that companies are going to deliver earnings, despite some of the weakness that we saw in macro data. The good news is that companies are so good at managing expectations that even when macro data came in below consensus, which is basically happening right now, companies beat consensus 91% of the time by 3% on average. So I think the momentum is still there for earnings.
The question is, how broad is the momentum for earnings, Ohsung? And that's something that you guys looked at in your note, right? Noting that, of course, the bulk of the earnings gains that we have seen in the prior few quarters has been from the Magnificent Seven. So what happens now?
Yeah, so we're seeing a diverging trend between the Magnificent Seven and the 493 happening this quarter. So the other 493 was basically in an earnings recession up until last quarter. We expect this earnings season is going to be the first quarter for the other 493 to post positive earnings growth since Q4 of 22. Whereas the Mag 7, their earnings growth is expected to decelerate for the second straight quarter, and again in Q3. And by Q4 of this year, consensus points to basically similar growth rates between the two. And I think that will really be the catalyst for the rotation in the market to take place.
And Go ahead, Ohsung, sorry.
Yeah, if you think about the leadership in the market over the past 2 years, it's really been driven by earnings. In 2022, tech underperformed because tech earnings lagged the S&P 500's earnings for the entire year. And tech's earnings bottomed in March of 23, and that's essentially when tech started outperforming. And going forward, if tech earnings are going to produce similar growth rate to the other 493, despite trading at such a big premium versus the other 493, then I think that should really be the catalyst for the rotation to take place.
And also, I'm curious, for the 493, you expect positive earnings growth. I'm just interested, what do you expect in terms of top line growth there?
Yeah, so I think for this quarter, I think it's going to be more driven by margins rather than top line growth. And that's typically how the earnings recovery starts. It typically starts with cost cutting and margin improvement, companies really trying to do what they can control. And then demand starts to improve, that's when operating leverage kicks in and you get further improvement in margins. And I think in the second half of the year, it's really going to be more driven by demand than anything else. We did some interesting analysis on what drives earnings. And at the end of the day, it's really about demand. A lot of people say, the disinflation trend that we are starting to see, that could put pressure on earnings. But what we found is that obviously there is a very strong correlation between sales growth and inflation. But when it comes to earnings growth, there's no statistical evidence that pricing or inflation drives earnings. The correlation is essentially zero over time. So whereas volume, demand obviously has very strong correlation to earnings growth. So I think going forward, it's really going to be about demand rather than inflation or pricing. And I do think that in the second half of the year, we could potentially see demand recover.
And what will drive that demand recovery? And is it contingent on the Fed starting its interest rate cutting cycle?
So until we see a real cutting cycle and a beginning of a new economic cycle, I think it's going to be more driven by mini inventory cycles here and there. I do think that the inventory cycle is turning. We have been in this destocking cycle over the past year to year and a half. And we have seen one of the sharpest destocking cycle in history. And if you look at the S&P 500's inventory levels, we basically hit the trough that we saw in the prior 3 recessions, and it started to moderate, suggesting that the destocking cycle is moderating. And I think in the second half of the year, driven by the inventory cycle, we could potentially see demand pick up.
Ohsung, I'm also curious when these companies offer, on their conference calls, when you hear from the CEO, the CFOs, they start offering their forecast, their guidance. What do you think we're going to hear there, Ohsung? I would suspect it's going to be pretty just cautious and conservative given the range of sort of uncertainties out there, the election, the Fed, the economy. But what are you listening for?
Yeah, all of the above. There's no reason for companies to guide aggressively. But the good news is that earnings continue to beat those expectations. Like I said, companies have gotten so good at managing expectations, and unless they see great reasons to raise their numbers, they're probably going to be on the side of being too cautious. And I think that's probably good for companies to actually beat those numbers in Q3 and Q4. And going forward, I think if the demand story comes back, driven by the inventory cycle, that's going to be a huge boost to earnings in the second half of the year. And I think key earnings to watch this earnings season is really going to be those companies that are very exposed to the inventory cycle, such as trucking, industrial semis that talked about potential bottom in Q2 last quarter, as well as short cycle industrials that could probably provide some insight on the inventory cycle.
And key not on that list is the mega cap tech stocks that we have relied so heavily on, Ohsung. Really interesting stuff, great analysis, and thanks for being here.
Thank you.